Stop. Before you let that number at the gas pump ruin your morning, I need to tell you a secret the nightly news won't. Every time a new war breaks out or oil prices skyrocket, the headlines scream the same thing: economic collapse imminent. It makes you want to sell everything and hide your cash under the mattress, right?
Well, what if I told you that for the last 35 years, these oil shocks have been nothing more than speed bumps on the road to massive wealth? Today, we're going to look at the cold, hard data from 1990 to right now in 2026. I'm going to show you why the smartest investors actually relax when oil spikes, and how you can do the same. If you want to protect your retirement while everyone else is panicking, stick around.
Just a note before we start. This video is for educational purposes only and is not financial advice. All investing involves risk, so always consult a professional before making investment decisions, as we cannot take liability for any financial losses. To understand your portfolio better, we have to talk about the energy tax. When oil gets expensive, it costs more to ship a sneaker from a factory to your door. It costs more for you to drive to work. Economists call this a tax because it sucks money out of the economy. But here's the fundamental difference you must understand. Oil is a consumable, it's a resource. We pump it, we burn it, it's gone. It has no internal growth. It just cycles up and down based on who is fighting whom. Stocks are productive engines. The S&P 500 isn't just a number, it's a collection of the 500 most powerful, innovative companies on Earth. These companies don't just sit there and take the energy tax, they adapt. They innovate. They find ways to be more efficient. While oil is a bet on geopolitics, the stock market is a bet on human ingenuity. One fluctuates, the other builds.
Let's look at the history books, not the headlines, but the actual data. First stop, 1990, the Gulf War. Iraq invades Kuwait, and suddenly oil doubles in price. In today's money, you were paying the equivalent of $90 a barrel. The market dipped because the world was bracing for war. But look what happened. By the time the conflict stabilized, the S&P 500 was already recovering. The fear was more volatile than the reality. Next, 2008, the monster spike. Everyone remembers the housing crash, but before that, oil hit its all-time real high. Adjusted for our 2026 dollars, oil was a mind-blowing $224 per barrel. It felt like the world was ending. But investors who didn't blink saw the S&P 500 embark on one of the longest bull markets in human history. The oil spike was just a shadow compared to the market's recovery. The recent past, 2022. Ukraine. When Russia invaded Ukraine, energy sanctions sent oil to $137 in today's money. Again, a kink in the market. Again, everyone panicked. And again, the market absorbed the cost and kept moving. Do you see the pattern yet? That brings us to right now, 2026. Problems in the Strait of Hormuz have pushed oil way up. If you look at the gas station down the street, it looks terrifying.
But look at the data. Today's price tag is nothing compared to the $224 of 2008 or the $137 of 2022. We have lived through much, much worse. While the media wants you to think this is a double whammy crisis, the S&P 500 is sitting at historic highs. Why? Because the companies you own are more energy efficient than they have ever been. They have already decoupled from the price of a barrel of crude.
Investing in oil is essentially a bet on geopolitics and weather. Over time, oil just doesn't stack up against stocks. The S&P 500 has averaged about 10% returns each year, while oil prices jump around and don't grow steadily. A barrel of oil is just raw input. You burn it once, and it's gone. A business generates value year after year. Even when oil prices spiked in 2008, the S&P 500 bounced back fast and kept climbing. That's what makes companies powerful. They adapt and thrive, no matter what happens to energy costs.
Don't get distracted by wild oil price spikes. They're just part of the story. The S&P 500 bounces back fast from world crises. For example, after the Gulf War in 1991, markets rebounded in 6 months and got right back to where they were. That's real strength. The market takes hits from rising energy costs, what I call the energy tax, meaning the extra money businesses spend when oil gets expensive, adapts, and keeps growing. At this point, as usual, let's bring in peer review Pete for the counter-argument.
Thanks, Kate. Well, I can't argue with history and your numbers, but the old saying goes, in the long run, we are all dead. Although historically, wars have had small, long-term consequences for share prices, we really can't totally forget commodity prices when looking at the markets. We have to look at long-term trends, however, and the fact is, long-term, the price of oil has been steady over the years.
Thanks, Pete. This is discussion, not direct investment advice, but if you're looking to fast track your background knowledge, I highly recommend picking up our comprehensive guide on Amazon. It consolidates the best insights from our first 30 videos into one high-level manual, complete with exclusive explanations you won't find on this channel. The link is in the description. Check out our other latest episodes on these links, and I'll see you in the next video.